Nagsend ako ng unang discussion pero ito pa lang mauuna, Introduction to Financial Management. So, ito munang di-discuss natin. First, let's discuss what finance is. Finance is defined by Webster's Dictionary as the system that includes circulation of money, granting of credit, the making of investments, and the provision of banking facilities. Finance has many facets, which makes it difficult to provide one concise definition. Though finance is quite a broad term, we can define it as having something to do with money, either giving money through credit, investing it through investments, or through banks. Areas of finance. Finance as taught in universities is generally divided into three areas: financial management, which is our subject, capital markets, and investments. We'll, we'll just be going over these three types, but we'll only be discussing financial management, obviously. Financial management, also called corporate finance, focuses on decisions relating to how much and what types of assets to acquire, how to raise the capital needed to purchase assets, and how to run the firm so as to maximize its value. The same principles apply to both for-profit and not-for-profit organizations. Financial management has something to do with, as the name suggests, management of the finances of a certain company. Unlike capital markets and investments, financial management is directed towards a certain firm or a certain company. Capital markets relate to markets where interest rates along with stock and bond prices are determined. Also studied here are the financial institutions that supply capital to businesses, banks, investment banks, stockbrokers, mutual funds, insurance companies, and the like bring together savers who have money to invest and and businesses, individuals, and other entities that need capital for various purposes. Government Governmental organizations such as Securities and Exchange Commission, which regulates the trading of stocks and bonds in public markets, are also studied as part of capital markets. Like we said, we're not going to discuss capital markets. We're just gonna define it and leave it here. Investments relate to decisions concerning stocks and bonds and include a number of activities. Security analysis deals with finding proper value of individual securities, i.e. stocks and bonds. Portfolio theory deals with the best way to structure portfolios or baskets of stocks and bonds. Rational investors want to hold diversified portfolios in order to limit risk, so choosing properly balanced portfolios is an important issue for any investor. Um, Market analysis deals with the issue of whether stock and bond markets at any given time are too high, too low, or about right. Included in market analysis is behavioral finance, where investor psychology is examined in an effort to determine if stock prices have been bid up to unreasonable heights in a speculative bubble or driven down to unreasonable lows in a fit of irrational pessimism. Like capital markets, we're not going to discuss investments, although we will be touching upon it, but we will not be thoroughly discussing it, so we will just gonna leave it at the definition. Finance versus economic, economics and accounting. Finance as we know it today grew out of economics and accounting. Economics developed the nation that the notion that an asset's value is based on future cash flows that assets will provide, and accountants provided information regarding the likely size of those cash flows. People who work in finance need knowledge to both economics and accounting. We move on to the forms of business organizations. The basics of financial management are the same for all businesses, large or small, regardless of how they are organized. Still, a firm's legal structure affects its operations, and that should be recognized. There are oh, I forgot to revise this. It's only supposed to be three. Sorry. There are three main forms of business organizations: pro- proprietorships or sole proprietorships, partnerships, and corporations. A proprietorship is a unincorporated business owned by one individual, while a partnership is a legal arrangement between two or more people who decided to do business together. Please take note that a partnership is two or more. It can be any number as long as it's more than one. A, propri- a proprietorship has advantages as well as limitations to it. First of all, they are easy and inexpensive to form. Uh, they are easy and inexpensive because there's only one owner. You can establish a business, any types of business, and it can be considered as a proprietorship. You can you can make an online business, and it's as long as you're the only owner or manager of it, then it's considered a proprietorship. They are subject to few government regulations because because it's not because it's not a big company or a big business. It's a relatively small business. There are few government or legal restrictions concerning proprietorship. They are subject to lower income taxes than are corporations. Basically, a proprietorship is like an individual. There's no specific type of tax considered in a proprietorship. While they have while a proprietorship have advantages, of course there's always some limitations. First of all is the unlimited person liability. When owning a proprietorship, there is no separate legal entity. This means that any liability of the business is the liability of the owner. So you cannot escape liability if your business cannot cannot pay them. The next is limited to the life of the individual who created it. Of course, because there's only one owner, the business automatically dissolves once the owner dies. Difficulty obtaining large sums of money. Again, because there's only one owner, it's difficult to get capital. It's difficult to get large sums of capital because there's only one person providing capital. Unlike partnerships or corporations which have multiple multiple people who can provide capital. Like proprietorship, a partnership has advantages and limitations. Uh, One advantage is a partnership can be established relatively easily and inexpensively, like a proprietorship. A partnership only needs the consent of two or more people. You can have a friend and talk with them and say that you want to start a business, and If he or she agrees, then that's already considered a partnership. There's no writing or contract needed. As long as both parties agree, then it's considered a partnership. Income is allocated on a pro rata basis to the partners and is taxed on an individual basis. This means that a partnership's income can be split between the partners, while while the income the income is taxed only on an individual basis, meaning that each partner is taxed separately and not to, and not and and not together, so it avoids a larger sum of tax. Limitations: unlimited personal liability. Like a proprietorship, a partnership generally can a partnership is a partner generally is not separate from the partnership. So meaning that if a partnership or the business runs out of money to pay pay the to pay the liabilities to pay its liabilities, creditors can go upon the partners to collect the sum owed to them. You cannot you cannot you cannot say that you're only a partner, because a partnership is not distinct from the partners generally, unless you're a limited partner. A corporation is a legal entity created by a state and it is separate and distinct from its owners and managers. Unlike unlike partnerships and proprietorships, a corporation is a separate legal entity, meaning that liabilities of the corporation is separate from the liabilities of the partners. Advantage includes stockholders' limited personal liability. Unlike proprietorship and partnership, a corporation, the lenders or creditors of corporation cannot go upon the stockholders, because a stockholder and a corporation are both separate legal entities. Corporations also have unlimited lives. Unlike partnerships, wherein if a partner dies, a partnership is forced to dissolve, but a corporation does not doesn't have this limitation. Even if the stockholders all die, a corporation still lives on. Limitation are double taxation. Taxation means that a certain income or a source of income is taxed twice. For example, a corporation's income is taxed separately, while while if that income is also subsequently well that in if that income is also subsequently given out as dividends, it's taxed again. So there's more tax that's being paid by a corporation than a partnership or a proprietorship. Now we move on to financial management. This the definition earlier is not the official definition of financial management. We will be using this definition Financial management means the planning, organizing, directing, and controlling the financial activities such as procurement and utilization of funds of the enterprise. It means applying general management principles to financial resources of the enterprise. Financial management deals with the funds of an enterprise. It deals with the utilization and procurement of the funds. Financial management has focuses on risk-return relationship, and the maximization of return for a given level of risk. Financial management is concerns itself with figuring out what to invest and if those investments have returns which is greater than the risk of investing. Financial managers attempt to achieve wealth maximization through daily activities such as credit and inventory management, and through longer term decisions related to raising funds. Financial managers are responsible for the decisions on credit and inventory management. For example, when will a company order its inventory? One cannot order continually order it because there are costs to order, like shipping fees for example, but a company also can't just order a lot at once because there's also cost in storing inventory. There's rent, there's electricity bills, and others. While long-term decisions related to raising funds, for example, is will a company rent a building or will it buy its own building? Is it cheaper to rent it in the long term, or is it more more profitable for the business to just construct its own building? Financial managers must carefully consider domestic and international business conditions in carrying out their responsibilities. Objectives of financial management. Financial management is generally concerned with procurement, allocation, and control of financial resources of a concern. Its objectives are to ensure regular and adequate supply of funds to the concern. Of course, like mentioned earlier, financial management is concerned with funds of a company or a business. It must ensure that a business has a regular and adequate supply of funds. To ensure adequate returns to the shareholders, which will depend upon the earning capacity, market price of the share, expectations of the shareholder. Of course, a business needs to please its shareholders. Shareholders are its investors, and one cannot just simply ignore its investors. To ensure optimum funds utilization. Once the funds are procured, they should be utilized in maximum possible way at least cost. Maximum possible way at least cost. So generally, one cannot just let funds or cash sit in the bank. One must also a financial manager must also invest in it in order to maximize the earning. But of course, a financial manager should consider the amount of investing and the amount that it should be kept, because because investing because investing is because investing has costs, and we need to minimize costs and maximize earnings in order for the funds to be utilized in the maximum possible way. To ensure safety on investment, i.e. funds should be invested in safe ventures so that adequate rate of return can be achieved. Please take note the rate of return. Um, we're not simply looking at the overall return, but the rate of return, meaning how 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 frequent of returns are we receiving, how much of returns are we achieving from these investments. One should consider all of this and more to plan a sound capital structure. There should be sound and fair composition of capital so that a balance is maintained between debt and equity. Capital structure can be obtained from debt and equity. Uh, Financial management's goal is to provide a capital structure in the least costly way, because getting capital has cost. When we get capital from debt, when we borrow money, we need to pay interest. But if we get it from equity, from selling shares, we need to pay off those shareholders using dividends, in the form of dividends. So the goal of financial management is to balance these costs. There should be a balance between debt and equity capital. Primary activities of a financial manager: estimation of capital requirements. A finance manager has to make estimations with regards to capital requirement of the company. This will depend upon expected costs and profits and future programs and policies of concern. Estimations have to be made in an adequate manner which increases earning capacity of the enterprise. So this includes estimations and forecasting. The financial manager has to estimate the amount of funds needed for the future based on the past transactions or events of the concern or a company. Next is determination of capital composition. Once the estimation have been made, the capital structure have to be decided. This involves short-term and long-term debt equity the analysis. This will depend upon the proportion of equity capital a company is possessing and additional funds which have to be raised from outside parties. These outside parties is the debt capital that I mentioned earlier. Like I said earlier, a financial manager has to determine the correct balance between debt and equity capital in order to lessen the cost of obtaining funds. Choice of sources of funds. For additional funds to be procured, the company has many choices like issue of shares and debentures, loans to be taken from banks and financial institutions, public deposits to be drawn like bonds, issuance of shares, like I said earlier, is a form of equity capital, while loans and bonds are a form of debt capitals. One should, a financial manager should carefully pick which the amount of capital that that should be obtained from all of this. Like I said earlier, every sources of capital has cost, and a financial manager needs to find a way to lessen the cost of obtaining capital. Investment of funds. The financial manager has to decide to allocate funds into profitable ventures so that there's safety on investment and regular returns is possible. So when investing, we need to invest in a profitable venture. Of course, we need to. Of course, the goal of investing is to get as much as return as possible. But just because just because an investment has a high rate of return doesn't mean that it's safe. So the there's also risks in investments. Inherent risks are present in investments, so a financial manager has to consider the safety and the rate of return of an investment. Disposal of surplus. The net profits decision has to be made by a finance manager. This can be done in two ways. Dividend declaration. It includes identifying the rate of dividends and other benefits like bonus. Retained profits. The volume has to be decided, which will depend upon ex- expansional, innovational, diversification, plans of the company. So when the company has computed its net profits, the financial manager has to decide what amount should be declared as dividend. Dividend is the amount. For those who don't know, dividend is the amount that is returned to the stockholders. The money that is being given to the stockholders are called dividends. Or or if the profit should be retained, retained profits can be used to to offset to offset expected losses in the future. Retained profits can also be used, like what's stated here, in expansional, innovational, and diversification plans of the company. So the financial manager has to determine the correct way, correct amount of dividends that should be declared and the profits that should be retained. Management of cash. Financial manager has to make decisions with regards to cash management. Cash is required for many purposes like payments of wages and salaries, payment of electricity and water bills, payment to creditors, meeting current liabilities, maintenance of enough stock, purchase of raw materials, and others. So, a financial manager has to decide what to do with cash. Cash can be invested, like stated earlier, or it can be kept in a bank. When kept in a bank, um, it is easier to get the money in case of payment of wages or liabilities. But not all of the money should be kept in the bank, because in order to maximize funds, it should also be invested. Financial controls. The financial manager has not only to plan procure and utilize funds, but he also has to exercise control over finances. This can be done through many techniques like ratio analysis, financial forecasting, cost and profit control. So all of this ratio analysis, financial forecasting, we will be discussing this in future meetings. And lastly, use of financial management in our daily lives. Students can use the different techniques in financial management, such as budgeting for predicting future expenses and allocating their current resources to cover future expenditures. So, when we receive allowance, we budget it for future expenses like rent, meal allowance, and others. Next is reconciliation of cash balances using statement of cash flows. Statement of cash flows is a statement where one can determine the flow of cash, where it where it went or where it came from. Um, Students may not use this specifically, but uh, maybe some it can be attributed when you when you trace where your money went, kung kung nagastos mo ba sa pagkain, kung meron ka bang natanggap from online business. When you trace the sources of cash, it can be it can be said that you are using statement of cash flows, but it's just that you're not using the formal one. Simple investment decisions like maybe buying shoes, buying clothes, buying cell phones and others. Types of investments. You're already using financial management. So that's all for this topic. Thank you for listening and next time ulit. Bye.